Our focus for today is the fact that oil prices have fallen, but we want to introduce some ideas that suggest that oil prices will get into the high 70s, mid 80 price range, and therefore cause the Fed to have a lot less concern about inflation, and everybody makes more money in the process. This is Greg for Teslafaninsight. Thanks once again for joining us. If this is your first time, welcome. If you're a repeat visitor, welcome back. We also want to thank our Patreon supporters. If you enjoy the show, would like more information on better investing and trading, join us on Patreon. We also have classes if that's of interest as well. We also want to note this is a copyrighted broadcast. So this is a little bit of deviation from our normal Tesla discussion to focus on oil prices. Oil prices are a big deal for everybody. It's 2% of everyone's cost typically. But when you consider the number of different products and services that Tesla offers, there's actually a lot of oil being used in producing all the metals used, and batteries, etc. I wouldn't be surprised if oil prices and their rise and fall represents, 25% of the cost of Tesla, going forward as a sort of underlying commodity. So something strange has been going on. If you look at the consumption of fuel in the United States, the highest consumption typically is between June and the September holiday period. So given that that's the case, one question pops up is, why are oil prices falling while the economy is actually pretty strong, which should suggest increasing oil prices based on increasing demand? Well, typically, if you ask the question, there's usually just a quick answer: supply and demand. If there's more supply, then if demand stays the same, price will fall. If demand falls, then that further helps prices to fall. So there's sort of a catch answer when it comes to where a price is headed. Now, why is this a big deal on oil prices? And the biggest deal right now is that you'll notice that the market rallied when it was announced that inflation was slightly down for this past month, noting that the Fed carefully tracks what's going on with this. Well, the only major decline in pricing was actually oil. So what I kept thinking about when it comes to oil is, yes, consumers have to spend money, but for example, any of the goods that are being taken to market rely on what the oil prices are. So there's a lot of ways in which those prices sort of push consumer prices higher. And the Fed is determined to lower prices or lower inflation through the technique of increasing interest rates. So it's something that we all have to keep an eye on, because one could end up with huge interest rates driven by the Fed's goal of sort of tamping down consumer consumption. I'd have to say I'm a little confused by the Fed's move in this regard, because in essence, for example, if you're a consumer and you're paying higher oil prices, you now have a difficult situation because you still have to go to work and you have to pay the higher oil price, and you paying that higher oil price means that there's been an increase in spending. And the spending increase wasn't because you bought a new house or diamonds or something. It just meant that the oil price went up and you still have to pay that oil price. So I did some digging on this, and some really interesting news popped up that we're going to find out how it plays out over the next couple of months, which is that China and India were able to negotiate a $35 price reduction on Russian oil as an incentive for them to take oil deliveries despite sanctions from all the Western countries. So my initial reaction to this when I found this out, I was like, this kind of makes some sense. So let's review how this is working out. If you look up what the numbers are, it turns out that China's consuming about 12 million barrels of oil a day. They're, I think, second behind the United States. The folks in India are something like 4 million barrels a day worth of consumption. So if you add them up, that's about 16 million, maybe 17 million barrels a day. And it turns out that for just round numbers, let's say these two customers represent 20% of the consumption of oil anywhere in the world. So where we're at now is in a situation where the Russians are supplying them with oil, and that oil is at a discount. Now, we're starting to ease into something called the prisoner's dilemma, where most of the goods and services you get are priced the way they are based on a game theory portion of economics called the prisoner's dilemma. And so basically, the general idea might be presented by the fact that if you have two gas stations on your street and one is selling gas for $1 less than the other, all the customers will go to the other one. So the other gas station actually has to lower their price, otherwise they go out of business. And so there's pressure between sellers for these items. Now, this whole system is working I believe, in a very strange way when it comes to Russian oil. Because let's say India and China had a number of vendors that were selling them oil. Let's say Company X or Country X. Now, both of those entities just lost all their customers. So the entity that lost the customers now has a decision to make. They could A, keep the market price of oil or gas and hope that they can attract customers back to fill up the 20% consumption that just disappeared to Russian supplies. And so they have a choice. They could keep world oil prices. Theoretically, they could raise prices and try to get people to come back. Or C, they could lower prices. And the question is, where is that price going to be lowered to? The answer is, we don't know what that lower price is going to be, but the general concept is that because Russia is discounting $35 a barrel, we're starting to see a phenomenon where the whole market is starting to move in the direction of the Russian discount. So the exact number from which we started for the $35 discount wasn't clear, but in theory, that's about $100 a barrel. It could be 105, it could be 110. Deduct $35 from that to come up with, ballpark what the number is that the Indians and the Chinese are paying for Russian oil. So a little sidebar note here. I keep seeing all these items about the economy of Russia is wrecked, et cetera, et cetera. And I guess I'm kind of shocked because, you can have a wrecking economy, but when customers are sending you $1 billion a day, the economy could be bad, but that's a lot of cash to address issues within your country, especially if you're not giving it to the oligarchs or putting it in Western accounts. So I have to say that I don't necessarily agree with this whole Russia's economy is in trouble, because just like the Chinese, they could choose to repurpose that cash to shore up their internal economy. And the other thing is that I'm just discussing the daily cash they're getting from oil. We aren't talking about what are they doing with natural gas, what's happening with coal, etc. So there are all these commodities that they have in large quantities that represent huge inflows of cash that other people that are having challenges do not have. So getting back to our discussion of oil prices currently and where they're going, it's my belief that there's a distinct possibility that the competing oil sellers to Russia around the world will simply have to lower their prices, and that will actually cause customers to say, well, why would I buy from Russia when the market price might be the same or slightly better? So therefore, countries that have decent margins on their oil don't have to worry about lowering their price. They're not thrilled, but they now are not without customers, which might be the case if they simply held their prices as high as they could. So obviously, I believe there are three possibilities. One possibility is that prices just rise because demand is so strong that it's going to force it up. We have a lot of new production going on in the United States, and that new production is impacting what the prices are going to be. The second thing that's going on is that, yes, so bottom line, the thesis is prices could rise, but in general, there's more production coming on, and prices have been lowered by one of the largest producers. So I'm thrilled to see us back in the 90s. It was in the 80s for the price of oil. And I believe that there's a distinct possibility in another few weeks, this ends up being an 80 to 85, maybe high 70s price for oil, driven by all the forces that I just discussed. So, and then by the way, if for some reason the war might end, obviously the prices would drop a lot more because the Russians' oil would therefore be welcomed back onto the market. So a few things to think about. So I believe all this is really important because there's a direct correlation between the price of oil and the Fed's sense of how aggressively to raise interest rates. And if these prices continue to fall and we're getting a break on inflation, I think it really helps the economy because consumers aren't getting destroyed by increasing interest rates that are being forced into place because of the Fed to protect against the impact of rising costs/prices. So something to think about as this starts moving more aggressively in one direction and not the other. I think we're going to see the answer to all of this. I also wanted to note too, Goldman is saying we're going to $150 a barrel. Teslafaninsight is saying we're going to approximately $75 a barrel. And let's see who's ending up being right, because Goldman does have the power to raise prices to wherever they want. We don't have the power to raise or lower prices, but it's clear that there are drivers that are getting it there. We look forward to your comments. This is a big deal for the whole economy. I look forward to any input you might have. This is Greg for Teslafaninsight. We also want to note our health tip for today. Don't forget your 25 leg lifts per leg to strengthen the quad muscles, reducing the chance for knee injury or surgeries. And then we have our back stretching coming up after our show that we're maintaining. Thanks once again for joining us. Tschüss, au revoir, lahitro, choda. Who are you with, Mark?
It's Renew Physiotherapy.
Great. So, Mark, every day we do a different exercise, and just wondered what you recommend that people do every day relative to the back.
If you could only do one exercise, what I would do would be to put your hands on your back like this. Do a back bend. Nice and easy, 10 times.
Okay.
And that will counteract all of the bending forward that we do throughout the day, whether it's sitting at the computer, sitting in the car, bending forward to get things and pick it up. Mm-hmm. Even when we sleep at night, people tend to curl up and bend forward. Mm-hmm. Doing just this nice, easy stretch 10 times, 4 to 5 times a day, will get your back healthy.
And your Renew Physiotherapy.
Renew Physiotherapy.
You also recommend the Cobra, where you're laying on your
stretch would be great, where you're laying on the ground and you push on up like this. And that'll help stretch out your spine.
Great.
Yeah.
Thank you very much, Mark.